A second recovery day for equities as rates stay elevated. 30 minutes until the start of trading. I'm Bonnie Quinn, stepping in for Matt Miller and Dani Berger. Bloomberg Open Interest starts right now. Coming up, the AI-led rebound continues with investors finding fresh reasons to stay bullish on tech. OpenAI confidentially files for an IPO as SpaceX prepares for its blockbuster debut later this week. And Apple gets a lukewarm reception as it makes the case that it can compete in the AI era. All right, let's take a look at some individual movers now. Stocks to watch. Tech obviously continuing to drive this market as semiconductor stocks rebound. Sentiment strong as investors gear up for the biggest IPO of all time, we assume, from SpaceX on Friday. This despite headwinds like aggressive short selling and potential chip curbs between Taiwan and China. Meanwhile, OpenAI has filed confidentially to go public, paving the way for another mega IPO. The ChatGPT maker is said to be targeting a listing as soon as this fall. Let's discuss now with Bloomberg IPO reporter Bailey Lipschultz. Bailey, did this take us by surprise, or should we have been expecting this, knowing that we already had one this week?
We had been expecting it. Again, the timing is interesting. A week ago on Monday, Anthropic announced they filed confidentially. The timing is also interesting because it's about 72 hours from the formal pricing of the SpaceX IPO. But it kind of has been well discussed that these are companies that want to go, I'm talking about OpenAI and Anthropic, public as soon as September or October.
Do they all end up shoring each other up or being disastrous for one another? So if one goes wrong, do they all go wrong?
I think that's a big question right now. Obviously, if SpaceX goes well, talking to bankers, it's going to be gangbusters, and we're going to see Jersey Mike's, SK Hynix, a number of other companies wanting to rush in and tap the market as quickly as possible. But if it falters, if it does break issue, if allocations are a bit kind of a drag for investors, we'll say, then I think it does raise questions. We're going to see a big test point Thursday and Friday, and obviously the weeks after that as it relates to SpaceX, and then we'll start to get a better sense if Anthropic and OpenAI are going to be welcomed with open arms.
Beyond being barometers for each other and barometers for how much sentiment there is out there in terms of positive sentiment or negative sentiment in the market, could they actually trigger some kind of an event in this market if something either goes right or goes wrong?
I think people are kind of bracing for that. We've seen a sell-off in memory stocks. We've seen Micron underperforming, and people are saying, okay, how much of that is retail shoring up capital to buy the SpaceX IPO? The one thing that's going to be interesting is we have 15 days from IPO to entry on NASDAQ 100, so SpaceX will be trading essentially by itself. The weeks and months, the next year, it's not going to be in the S&P 500. Is that a source of alpha for active investors who want to diversify? Or is it a potential vacuum suck where people are selling stocks in the S&P 500 to buy SpaceX? And what does that ultimately mean? Those are questions that investors are right now kind of debating.
Well, I watched a lot of IPOs, and they don't all pop. They may pop for the first few minutes, but then it's a lot of price discovery before they sort of settle down, right, Bailey?
It'll be interesting.
Bailey, you're going to be taking us through it the whole time between now and when all of those companies go public. Our thanks to Bailey Lipschultz. Turning to Apple's latest updates now. The company is delaying its new Siri AI in the European Union due to antitrust issues. The company's new AI feature is giving investors a glimpse into an upcoming generation of products. Bloomberg Tech co-host Caroline Hyde joins me. Caroline, if they have to delay Siri in the European Union because it doesn't adhere to the DMA, right, the Digital Markets Act, is there anything that we in the US should be maybe concerned about, user privacy-wise?
Well, I think there's some mudslinging going on at the moment. The EU is saying this is Apple's choice and Apple alone. There is nothing within the DMA, the Digital Markets Act, that prevents them from offering Siri AI at the same sort of time frame as we would get in the United States. Now, meanwhile, the EU is saying, meanwhile, Apple's coming back saying, look, if you enforce the tough reading of your rules as we currently see it, it would mean, in their sort of overall focuses, is that we would have to sort of bend some of the essential protections that we hold so dear. We would allow rivals to get access to user data. We would have concerns with that. So at the moment, the EU is trying to point more broadly to what they want is big tech not hiding out other competition. And within this, Siri AI is meant to obviously give access to its own underlying technologies. But many would say in the EU, well, I want to just be able to access whichever chatbot I want to use, no matter who it is. Now, At the moment, the tough reading of the rules, as Apple sees it, is that, look, they would just be giving their user data to those that they deem rivals, and that maybe the protections would be eased here. So I think there's more broadly a concern with timing all round. Like, this is why the stock dipped. This is why Apple was lower yesterday, why it's trading lower in pre-market, is that we're likely only to get it in beta version, Siri AI, when it comes out in September on an operating system that's upgraded to 27. We wanted it not in beta version. We wanted it fully fleshed. We wanted it to be working, to be able to understand how it integrates between apps, to be able to have a really great user experience. So that's why the stock is dipping. But more broadly, it is notable that once again, EU and Apple are clashing. Also, China and Apple are clashing.
Yeah, absolutely. But before we get to that, I just want to say I'm not sure I want it at all in beta version or any version. It's going to be able to tell you answers to questions based on your messages, your emails, everything that's yours inside that phone, which I guess it already knows and it can already track through. But I'm not sure I want to be asking it questions out loud and getting out loud answers back.
Therein lies your personal concerns with privacy and with AI. But there's an awful lot of people out there who've used something called OpenClaw, which at the time was just able to start firing off messages using your own messages at the moment and being able to spam worldwide, being able to automate. For many, this has always been the tech issue. How much do you rate privacy? How much do you rate actually just making your life easier? How much are you okay with Uber knowing where you are at all times? How much are you okay with the fact that apps have to track you? Well, in many ways, the quid pro quo has been because it makes your life easier. Now, Apple has always put privacy first. Perhaps that's always been its calling card over and above some other rivals. But on this particular occasion, I think it's trying to hit back at the EU because in many ways, EU regulation has always taken great aim at big tech. And they feel that perhaps they're just allowing competition for their rivals a little bit too much.
Separate story this morning, a line crossing the Bloomberg that Taiwan is considering curbing chip exports to China in order to align with the United States.
Extraordinary, really, if you think about it. I mean, China still thinks Taiwan as its own. And the fact that Taiwan would put on tougher regulation on some of the most sophisticated chips and technology going from Taiwan into China would be a big issue. And at the same time, you're seeing the United States Pentagon saying, well, actually, we still deem some of your biggest tech giants, Alibaba, Tencent, and the like, as closely affiliated with the military, and therefore a key risk for us. Every day, I seem to feel like we're getting whipsawed on whether the relationship between US and China is growing closer or whether it's getting further apart. And on this particular perspective, it feels as though Taiwan is getting in lockstep more with the United States in the same way that Japan has been asked to do, in the same way that the Dutch have been asked to do with ASML. And now it seems as though Taiwan is having to dance the tune as well.
These are a lot of nettling questions, though, because you can only imagine that this will poke China more and perhaps make China want to, bring that timetable forward where it thinks it's going to, receive Taiwan back into the fold, if you like. Caroline, thank you so much. Bloomberg Tech's Caroline Hyde. Joining me now is Charles Schwab, Chief Investment Strategist, Liz and Sonders. Liz, thrilled to have you.
Thank you.
Just this Taiwan story, it's a little odd, the timing of it, right? So Taiwan obviously cozying up to the United States a little bit, also keeping China's pressure off. I mean, at some point, does this escalate more, and does China sort of take a little bit more of a
Was
robust
I billed
stance?
to you as a geopolitical strategist today?
No, but you must be thinking about the idea that 2027 is coming up, and that was
Yeah.
the deadline that China had set for sort of reincorporating what it thinks of as Taiwan into its fold.
Yeah, and to me, the bigger story here is just how important a nation like that has become to this broader technology story, the AI story. So in the past, we thought about tensions between China and Taiwan as more just geopolitical. But now it is more economic than I think people have thought about in the past. So there's a different lens being used to understand the importance of Taiwan.
Lizanne, just more broadly on this market, how healthy is it? So you go home on Friday, and you got to think that a lot of people were putting plan Bs together. That they were thinking, what am I going to do Monday, And then Tuesday comes and we're looking at a second day of recovery, and we may even be back to where we were Thursday evening.
I think that's the nature of the market right now, especially as it relates to positioning associated with the most significant cohorts that are driving day-to-day activity. So you've got the long-short hedge fund community, the systematics, the commodity trading advisors, and then that sort of fourth cohort of the retail trader, separate and distinct from individual investors. And for the most part, those cohorts are playing a really, really, really short-term game. And they key off technicals, they key off positioning of the other cohorts. So you get these dramatic whipsaw kind of moves, because a day like Friday, where you actually saw the AI trade really, really suffer, but anything non-AI actually was up on the day on Friday. So you worked off some of the severely overbought conditions fairly quickly on Friday. That meant that you saw some of those shorter-term players step back in. And it's not really been the retail trader recently. So it's not so much a FOMO kind of thing, which tends to be the acronym that defines the retail traders. But I think these kind of rapid-fire moves and the rotations that happen and turn on a dime, I don't see that backdrop changing anytime soon.
So is the market overall fairly valued then? And when we do see some kind of a shift, it'll more be a shift in terms of what people are owning as opposed to the fact that they are actually owning the S&P 500, let's say.
You know, fairly valued is an interesting term. The one thing I always caution with our investors when we talk about valuations is that they're not entry and exit points. Valuation, if anything, is an indicator of sentiment. It doesn't give you any perspective on what the market is going to do. That said, you do tend to see upward pressure on valuations, which is good, when you've got downward pressure in terms of either interest rates or inflation. That is not happening right now. So all else equal, the inflation backdrop is not quite supportive of valuations where they are. The good news is that the denominator in the PE equation has been on fire. So you've actually seen some lessening of valuation concerns by virtue of earnings growth moving sharply higher at a greater pace than what we've seen in terms of price appreciation.
And you have to wonder how many more quarters that's going to continue on for. We'll continue this conversation right on that note in just a moment. But let's take a look at these markets now as we approach the opening bell. We do have futures higher, so we have S&P futures up another 0.5%. NASDAQ 100 futures pointing to a gain of almost 1% at the open. Remember, the NASDAQ was up 1.6%, having been down quite substantially. The SOX was down 5.6% on Friday. Those yields are staying elevated, even if we're off a couple of basis points. That 10-year yield, 4.53. Perhaps nothing alarming yet, but the 30-year yield is above 5, and we do have the 2-year yield well above the upper band of the Fed's policy range. Brent crude trading at $92.50. Let's get another look at some other movers on our radar now. SailPoint had earnings this morning, beat estimates and boosted their full-year operating income forecast. But as we've seen so often, that was not enough to impress investors, or at least some of them sold on the news. Neo-cloud firm Applied Digital as well, inking a 15-year lease with an unnamed AI hyperscaler worth more than $5 billion in revenue, and that's seeing a nice pop as well. I don't know why they don't name these hyperscalers pretty immediately. We always have to wait a few hours. GSK buying US cancer drug maker Nuvalent for more than $10 billion, the British pharmaceutical company rebuilding its oncology franchise. Coming up, as you saw, Brent crude moving lower as hopes for a US-Iran deal grow. That's next. This is Bloomberg Open Interest. Now to high interest to look at what's making headlines around the world. CoreWeave's founders have sold more than $2.3 billion in stock since the AI cloud company's IPO, cashing in after shares surged more than 150%. The sales were made through pre-arranged trading plans, and founders still own major stakes. But the insider selling is drawing fresh scrutiny as CoreWeave continues heavy spending and remains unprofitable. The Knicks dropped their first home NBA Finals game at Madison Square Garden since 1999, falling to the Spurs 115-111. Demand for tickets reached historic levels, with some courtside seats listed for 6 figures. President Trump, Mayor Zoran Mamdani, and a host of New York celebrities packed the Garden as the series now heads to a pivotal Game 4. Brent is moving lower after Israel and Iran agreed to stop strikes against each other and threatened to derail peace negotiations. President Trump, speaking in New York last night, said a deal is close and could come within days.
We have ongoing negotiations with Iran that hasn't stopped. We're in the final throes of what will be a very, very good deal that will not allow in any way, shape, or form nuclear weapons, etc. And the Strait will open up right away. It'll open up immediately upon signing, which could be in 2 or 3 days.
Joining us now is Bloomberg Washington correspondent Tyler Kendall. So those over and back strikes, Tyler, had threatened to derail that process. That process didn't seem to get derailed. Where do we stand now? Because certainly oil is pricing in some kind of a resolution at some point.
Well, Vani, at this point, the White House is expressing optimism and has made very clear that it is committed to finding a diplomatic solution, which is part of why we saw President Trump directly involved in those negotiations to get Israel and Iran to stop firing on each other, at least for now. He went on to tell reporters last night that he expects those two sides to cease their hostilities for at least another week, in his words, though we know that the threat of escalation still remains. And part of that is because Iran has repeatedly demanded that any ceasefire needs to extend to Israel's operation against the Iranian-backed militant group Hezbollah, something that it appears increasingly unlikely that Israel is going to agree to. Still, at this point, people familiar with the matter do tell us here at Bloomberg News that the negotiations for a broader U.S.-Iran deal remain intense and ongoing this week, with Pakistan still a key mediator. Something that has become increasingly clear, though, is that until a deal is reached, the U.S. is still going to ramp up its economic pressure and keep that U.S. naval blockade in place. In fact, new this morning, CENTCOM confirmed that the U.S. military fired on an empty oil tanker with suspected links to the Iranian oil trade. Vani, according to CENTCOM, so far they have intercepted at least 7 vessels and redirected 134 more.
Right, Tyler, so the president definitely underscoring that the U.S. blockade is still in place. Iran, though, also has what's essentially a blockade. Ships are not getting through the strait. Does the extension of a ceasefire do anything in terms of moving things along in the strait?
We've seen some more movement, as you know, over the weekend. But, Vani, actually, we should point out that there's now a new heightened threat against commercial shipping, as we hear from another Iranian-backed proxy group, the Houthis in Yemen, out yesterday with a statement saying that they are going to work to ban any Israeli ships that are transiting near the Red Sea. Their statement did not say that this would extend to all commercial shipping, but it does heighten this threat that we could see more disruptions for what is considered to be a key bypass route when it comes to the Strait of Hormuz. That is just raising the stakes even higher as these negotiations do continue. We know, though, that the White House says that it will prioritize opening the strait in any potential deal. But at this point, we're still trying to glean any sort of details on what this memorandum of understanding would look like. The other week, it was our understanding that this would be a short-term pause in the fighting, get the Strait of Hormuz reopened, get the U.S. to lift its naval blockade, and then talks about curbs to Iran's nuclear program would come later. Still our understanding this is what they are trying to work towards, but at this point we haven't gotten that official confirmation from either side that they're on the brink of a deal.
All right, Tyler, thank you so much. Bloomberg's Tyler Kendall there in Washington. Still with us, Charles Schwab, Chief Investment Strategist, Lisanne Sonders. Lisanne, we were just talking about earnings and how they've been beating, but I have to make a little detour and ask about oil, because we were looking at the front month contract, right? And it has come down a lot. And if you look at December, we're still looking at 84, roughly where we were the whole way through this war. Is the market a little bit in denial about the type of impact that, you know, higher oil prices could have on earnings?
I think maybe complacent is probably the right descriptor. And I think it was last week that leaders within both Chevron and Exxon came out and said that given how low stockpiles are, that without a relatively imminent opening of the Strait of Hormuz and getting that oil flowing again, they cited numbers as much as 150 in a matter of a few weeks. So we are sort of on the brink of what potentially could be a more significant spike. We're still in an inverse correlation territory between oil prices and the stock market. So some of the turnaround that we already talked about was a function of this move down. But there's been so many fits and starts in the announcements of an imminent deal, and then we don't get one, an announcement of an imminent opening of the strait. So time is not on the side of the economic bulls as it relates to the oil price channel.
So between that and the inflation data that we're going to get tomorrow, the Fed meeting next week, there's a lot of uncertainty out there for the stock market and I guess for companies in general. What do you do in that situation?
I think that what the market is pricing in now, which is now a little bit earlier, an initial rate hike, pretty much pricing out rate cuts. I think that will be potentially a volatility driver. But also the reaction function on the part of the bond market, specifically the 10-year yield, which right now also has a pretty sharp inverse correlation between equity prices. to me, the most interesting thing that's going to happen over the next week or two is the Fed meeting, not because of any expectation that they're going to do something, but under new leadership of Warsh, who came in with an assumption that he was going to take a more dovish stance. I think the ability for him to telegraph that has altered quite dramatically, not to mention the fact that, and I get questions all the time about, well, if Warsh wants to cut, what do you think the impact on the market is going to be? Well, Warsh is one person. The C in FOMC stands for committee. It doesn't stand for chair. So you have to get 7 people on board. And the commentary coming from Fed officials is not suggestive of an easing bias by any means. So I think we may see the first step in what will be a telegraphing process, maybe just by dropping the easing bias within the statement.
And the balance sheet, how much can he do through the balance sheet mechanism? We have to talk more about this in just a moment after we get the market open. Lizanne is sticking around, luckily. Coming up next hour, more on geopolitical and inflation risks with JPMorgan's Meera Pandit as well. This is Bloomberg Open Interest. Let's get a look at some other movers now on our radar. We have AST SpaceMobile launching its next satellites June 17th as it expands its direct-to-device broadband network. That stock up 7%. Vail Resorts, well, it cut its net income guidance for the full year due to challenging weather conditions in the western U.S. That stock off just a little bit, down about 3.1%. And we had earnings this morning. JM Smucker profits were above estimates as the high price of coffee helped boost earnings. Let's get a check on markets generally now ahead of the opening bell. It looks like it might be a positive day all day long here, at least for equities. We are seeing futures pointed higher on all the major indices after a gain day yesterday as well. This to make up for last Friday's suffering on the part of many traders. We have rates elevated as well, down about a basis point across the board. And then we also have Brent crude trading lower, just around $92 a barrel. We begin the trading day with Lizanne Sonders next. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Bonnie Quinn, stepping in for Matt Miller and Dani Berger. And it looks like we might have a second day of gains coming up on our hands with futures all pointed higher. If we take a look at the NYSE, we have the HUD Secretary ringing the opening bell. In fact, on the NYSE, I don't know if you know, but it is home ownership month, would you believe? So that's why the HUD Secretary, Scott Turner, is down at the NYSE celebrating that with some associates. And then on the New York Stock Exchange, or in fact the NASDAQ, we have CoreWeave. It's a managed care company, about $3 billion. Another Texas little connection here. Of course, the HUD Secretary from Texas, and this company is based in Fort Worth. Let's take a look at some of the stocks on the move in the pre-market. We have Nvidia, Micron, Marvell, all of the AI-related names back up again, about 1% for Nvidia, Micron, more than 3.5% in Marvell. These are all almost back to where they were Thursday evening before we saw that sell-off on Friday. A massive day for these companies yesterday as well. The semiconductor index, the Philly SOX, was down more than 10% on Friday. Well, we retraced more than 5% of that yesterday, so we'll see how these companies can do today. But it is essentially a green day for equities across the board. Tech continuing then as sentiment gets stronger, and of course the SpaceX IPO coming up Friday. The headwinds like short selling though, and positioning in terms of shorts still in this market, and lots of red flags as pointed out by Savita Subramanian of Bank of America Securities today. So let's get back to our guest on this now. Joining me is Charles Schwab, Chief Investment Strategist Lizanne Sonders. Lizanne, these red flags, some of them were named by Savita Subramanian and the team at Bank of America Securities. So, things like consumer sentiment, business sentiment, PE ratios and so on. She said 70% of them are now flashing red flags. Would you be that concerned, or would you say, well, maybe it's not quite 70 in what I'm looking at, it's maybe more 65, 60?
There are a lot of red flags right now. Not just consumer sentiment and business sentiment. We got the NFIB data out this morning, and it was weaker than expected, and the outlook was also weaker, and that's important because that's the leading indicator component of this. Consumer sentiment, certainly the UMISH version of consumer sentiment is at all-time record lows. I think, though, that you still have a big disconnect between the soft economic data, the survey-based data like business sentiment and consumer sentiment, and the actual hard data in the economy. I think right now you could argue we're in a bit of an inflationary boom. I do think, though, that one of the risks is that the boom part of that changes and that there is the possibility of some weaker growth, driven in part by the inflation problem. You know, the old adage about high prices is the cure for high prices because you get some of that demand destruction. So I think we need to be mindful of that. But I also think that we could continue to have a correction via a process of rotation. You know, the S&P at the index level didn't have a correction level maximum drawdown this year. Its weakness in February and March hit 9% and change, so shy of that official 10% correction. But if you go member by member in the S&P 500 and look at their individual maximum drawdowns and then take an average of that, it's negative 22%. In the case of the NASDAQ, the average member maximum drawdown is negative 38%. So you could continue to have, whether it's a correction of valuation excess or a correction of sentiment excess, occur via a process of rotation as opposed to a correction happening all at once at the index level.
That's a very pleasant thought.
That's not a bad way to go through a corrective phase.
Right, exactly.
Yeah.
We were talking about Kevin Warsh a few minutes ago, and I know you said it's a committee and it's all going to be done by consensus. However, he's going to want to try to be very helpful in that regard and try and get a consensus, but one that, you know, reflects his opinions. How much will he do with just the balance sheet in terms of rate setting, if you like?
Yeah, that we don't know. I mean, he's been on record and fairly vocal about believing there should be a smaller balance sheet than what the Fed has right now. But, and full disclosure, I've known Kevin for about 23 years. I don't stay in touch with him on a day-to-day basis. He's not asking for my opinion.
No, but he has been a market participant.
Yeah, and I think he's a very smart guy, very practical guy. He understands the relationship between the levers that the Fed can pull, both on the balance sheet side and on the rate side, particularly as it relates to the bond market. And I think any sort of overt attempt to bring easier policy in the mix, not likely on the balance sheet side because he generally wants a smaller balance sheet, but on the rate side, the reaction function on the part of the bond market is important. And we've learned that with the Fed under Powell. 2 falls, autumns, I should say, in a row where the Fed started to embark on easier policy, and the bond market actually said, you're going too far here. So that first attempt a year and a half ago at easing policy, the Fed cut rates by 100 basis points, and over the same span of time, the 10-year yield went up by 100 basis points. And that's what impacts the economy through the channels of things like mortgage rates. So I think Kevin, like any Fed appropriate policy, is going to heed any messages that come from the bond market that may at times be in stark contrast to what the goal is on the short-term Fed funds rate side.
Well, you could say the bond market's already sending out signals, right? I mean, very drastically at the front end at the moment. Will he, and will the committee, let's not just talk about Kevin Warsh, will the FOMC be in trouble in the sense that it may need to hike, you know, sooner rather than later, but yet there are the midterms coming up, and anything it does between now and the midterms will be seen as politicized?
You know what, I think that's part of the reason why maybe the market is pricing in the first hike not coming until the December meeting, which puts you after the midterms and therefore maybe lessens concern about political influence on the Fed. So given what we know now, and that's such an important caveat, given what we know now, the Fed should lean more toward the hiking end of the spectrum versus the easing end. If the inflation story was just about oil prices, I wouldn't say that, because the reason why the Fed and most economists and market watchers look at core measures is if an inflation move up is solely driven by oil prices, the Fed hiking rates doesn't directly bring oil prices down and then potentially causes economic problems, which higher oil prices are already in the process of doing. So, but we've got, the inflation problem was a little broader than that. We have seen an increase in money supply. We're seeing the AI feeder into inflation right now with some of the supply chain disruption. So it has become a broader inflation story, which is why the market is looking at a hike being the next move. But I think you're right. I think the goal would be not to do anything in advance of, certainly immediately in advance of the midterms.
So the market's looking, or at least consensus is looking for a 4% handle for the inflation data tomorrow, 4.2% year over year. If we get something a little softer than that, or even if it comes in around that, knowing what we know, and that there is some kind of an oil element to this, is there any case to be made for the Fed to not have to do that, to do this? That the Fed
could... Yeah, I mean, I think the default right now is the Fed is in a timeout, and they'll stay in a timeout. I think that is the default. I think it could change on the margin, the timing that the market is pricing in terms of rate hikes or what percentage likelihood that is. But Vonnie, I also think that every single inflation data point that comes out, every single labor market data point that comes out can and has been moving the needle in terms of rate change expectations. Whether or not the Fed views themselves as still being data dependent, I think market pricing suggests that we are data dependent in terms of expectations around Fed policy.
All right, Liz, thank you so much.
My
Liz
pleasure.
Ann Sonders,
Thanks for having me.
always with all sorts of clarity on these markets, and boy, do we need it right now. Well, let's get a check on the stock market and these moves today as we approach about 8 minutes into this trading session, and it does look like we have a nice rally on our hands with more companies up than down, 380 companies higher in the S&P 500, about 122 lower. That's, of course, in the first half hour of trading. Can't count on that being the case all day, as we know. Many of these are, of course, the tech-related companies, the semiconductor companies, the Microns, your Nvidias. Obviously, these are all also the points leaders when it comes to that as well. We're seeing airlines and banks, in fact. Look at JPMorgan with a nice gain there of more than 5%. Airlines, too, also participating in this rally. And to the downside, you do see some of those energy companies, as you might anticipate, with oil to the downside to the tune of 2 or 3%. We also have some of those services companies, ServiceNow, CrowdStrike, and Palo Alto Networks, some of the software companies, just selling off just a little bit again today. All right, coming up here on Open Interest, we're going to be speaking about Apple's foldable iPhone and, of course, Apple's AI strategy. That's after the WWDC. This is Bloomberg. Time now for our top call. Some of the analyst action in focus this morning. First off, KBW is upgrading Toll Brothers, downgrading Lennar, saying the K-shaped housing market favors affluent buyers, while entry-level shoppers remain squeezed by higher housing costs, weak confidence, job uncertainty, and, of course, elevated mortgage rates. Next up, Citi bullish on lithium stocks. The firm says the worst of lithium sell-off is likely over and expects prices to recover as battery makers restock ahead of the August and September production ramp for electric vehicles. And finally, Wall Street a little divided on Apple's AI event. Baird optimistic on a revamped Siri, but it's flagging timing uncertainty. Wedbush, meanwhile, calling the event an important step to unlocking AI monetization. But Wedbush more skeptical on the fact that AI announcements lacked a breakthrough moment. At the same time, Apple's new operating systems may be offering clues about what's next. The latest iOS updates offer signs of the company's upcoming foldable iPhone, including references to folding hardware and new features for larger displays. Bloomberg's Ryan Blastelica joins me now with more. So Ryan, what do we know about all these hints and signals and iOS sort of flags that are being put out there about what's actually coming in September?
Well, people have been expecting a foldable iPhone for a while now, and there's a lot of growing excitement and optimism that, in addition to some of the AI features, a foldable iPhone is going to be different enough that people might be more tempted than they have been in past generations to upgrade their phones, which, of course, is what is really needed for Apple to sustain some of the recent improvement and revenue growth that they've experienced.
Now, as I understand it, these foldable iPhones are massive when they're unfolded, right? So they're almost more like iPads. It's not, you know, the old Motorola flip phone of old.
It's certainly not the old flip phone, but I think we're still waiting to see a lot of the exact specifications, all the other details. I think they're going to be unveiled later on this year, but certainly yesterday at the WWDC event, they didn't talk about that. They talked a lot about their AI strategy and how they're going to start incorporating some of these new features really into the operating system, into the Siri digital assistant to help coordinate amongst all the different apps. So that's certainly at least the focus in the near term. Foldable phone, maybe a catalyst for later on this year.
What about wearables and back to the glasses idea that sort of didn't work so well the first time around for the likes of Meta, but might actually start working for Apple?
Yeah, I think wearables is something that people are paying a lot of attention to right now. If you think about what is this business going to look like 10 years from now, there are some speculation that maybe wearables like glasses could be something like a category killer for the smartphone. Now, that's very speculative at this point, but a lot of investment is going into wearables, into glasses, into the Apple Watch, AirPods, all these different sort of things that are away from the traditional smartphone. There's a lot of interest and excitement in there, but at the moment it's very premature to say that glasses or some other sort of thing is going to be an iPhone killer.
Yeah, I mean, also the idea that some of these things are going to be quite expensive, right? So that foldable phone we were talking about, we're looking at something like $2,000 potentially. Some of these wearables, could we be looking at a similar price point? And I guess after these market gains, does it really matter?
Well, the market gains do indicate that there maybe is some rising expectation for Apple being able to execute on all of this stuff. Obviously, they first introduced some AI features a couple of years ago. They had some delays, they had some issues with the product, and we did see a lot of volatility in the stock as investors sort of figured out how important is AI going to be to Apple, how strong are they going to be in this market. It does seem like there is some growing optimism that they will be able to compete, that their AI services, especially ones that are being done in conjunction with Alphabet's Gemini, that they will be able to be strong enough to sort of justify all the expense and justify people trading up for them. But right now we just don't know, and the fact that we saw a negative reaction in the stock yesterday, maybe that was just some profit taking, maybe a little bit of sell the news, but also just maybe a little bit of a sense that maybe some people were underwhelmed by what was unveiled.
Yeah, also the idea that Apple is going to have to delay Siri in Europe. It's going to have to finesse some of these products to meet the DMA, the Digital Market Act regulations. Is there anything that we should be worried about, Ryan, in terms of privacy, or have we got maybe too lax with our details, given that you can now ask Siri to rifle through your photographs and answer questions based on them?
Well, privacy was a major focus of the keynote presentation yesterday. Apple really centered that, you can use this AI without it being a real privacy risk to you. They took a couple of, subtle shots at a competitor saying, you can use these things without it tracking you. But as far as what that's going to mean for the stock, it's hard to say. Again, I think people are maybe a little bit disappointed that all of these features aren't going to be immediately available. I believe they are for developers, but it's going to be released in September here and in other parts of the world later on. I think that might have been something of a disappointment to some people, or at least factored into when we might start to see an upgrade cycle really pick up.
For sure, people do like their September releases. Ryan, thank you so much. That is Bloomberg's Ryan Vlastelica. Coming up, Treasury yields sending Kevin Warsh a clear message the Fed may not be done hiking. Details next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. Check on stocks now, and it's a little bit of everything for us today. We have the major indices higher and retracing those declines of Friday yet again today for a second day. So the S&P up 1%, the Nasdaq up 1.2%, the Russell 2000 with a massive gain, 2.2% for those smaller stocks, and the Philly Semiconductor Index really ramping up now after yesterday's 5.6% gain, up 2.5%. Some of the reasons why are over here. Applied Digital, for example, getting into a deal with a hyperscaler to be revealed. This is another big reveal, I guess. Maybe that'll help the stock even more. But a 15-year deal has that stock up 10%. Micron up another 3%. Nvidia doesn't have many down days, back up to $210 a share. It is up about 0.8%. The 10-year yield down a couple of basis points, but still elevated. That may be one of the things that we will be watching for into tomorrow's CPI data and the Fed meeting next week. Brent crude down more than 3%. Look at that. It was trading below $91 just a little while ago. And then, of course, we have a deal. Nuvalent being bought by GSK. Nuvalent soaring and not not doing too badly for GSK either. But let's get back to those rates then, because at the front end of the curve, you are seeing the market send the Fed, and not just Kevin Warsh, a signal that we have the band, 325 to 375, and yet that 2-year rate is currently at 4.13, and that's down from where it was just a couple of days ago. So yields climbing above the Fed's policy rate. What does it all mean, particularly when we're looking at CPI data in the morning and into the first Fed meeting under Fed Chair Kevin Warsh? There's only one person to ask, and that's Ira Jersey, Chief Interest Rate Strategist for Bloomberg Intelligence. How will Kevin Warsh meet this moment, Ira? Everybody always says, look, it's a committee and so on, but all eyes will be on the new chair and what he says about the difference in front-end yields between the policy rate and what's out there in the market.
Yeah, presumably he's going to be asked about that at next week's meeting. You know, is the market telling you that you have to hike interest rates? The market's not exactly saying that. I disagree with the notion that the market's telling the Fed it has to hike interest rates. What it's really pricing, remember the market prices for forward expectations, is either a string of interest rate hikes or unchanged rates. And this is the kind of the bimodal potential outcome that I think the market's trying to contend with. And you can really see this if you look at the options market. And when you look at options on SOFR, on short-term interest rate futures, what you see is that there's around a 30% chance of 100 basis points of interest rate hikes and a 30% chance of the Fed doing nothing. So this is kind of the midpoint of those two different outcomes, which we don't know what's going to happen. So it's kind of the market's way of saying, hey, let's price some uncertainty risk and let's price that risk into the market. And that's where you see 2-year yield just a little bit above 4%.
Ira, is there any kind of prevailing view anywhere now that just reducing the money supply will help in terms of inflation and inflation expectations? And will that form part of the next committee's, modus operandus?
Well, I don't think so. Kevin Warsh would like to shrink the balance sheet, but the challenge with that, and I think he'll find this out very quickly when he starts speaking regularly with the large banks that provide liquidity into funding markets. So when you look at something like the repurchase agreement market, which is really the grease that underlies all financial activity in the world, really, and in the U.S. in particular, whenever you get reserve balances down toward certain levels, you end up seeing the funding markets and the repurchase agreement market really start to go haywire. That's what happened in December, and that's one of the reasons why the Fed has been buying Treasury bills in order to kind of keep bank reserves at a certain level, right around where they are now, quite frankly, in order to ensure that funding markets are acting properly and are stable. And that is one of the Fed's mandates. We have to remember, we always talk about the dual mandate, but they also have a financial stability mandate, and that's where reserves come in. Can Kevin Warsh get the balance sheet down? The answer is yes, if, and I think only if, they're able to change some bank regulations to allow banks to not have to hold quite as many reserves.
Ira, does Kevin Warsh have a predisposition, and we're concentrating just on the Fed chair now, so yes, he talks a lot about productivity, American exceptionalism, the growth of the United States and how it can continue to grow. That would seem to suggest that he would want to keep rates low, yet we know he's also a conservative economist. What is he coming into the job predisposed to? A rate hike or a rate decrease?
Well, so I think Kevin Warsh is a little bit more middle of the road. He would like the lower interest rates and also shrink the Fed's balance sheet. Like that was one of the policy angles that he had expressed earlier. I think that he would like to cut interest rates just because he thinks maybe keep the president happy, certainly, but also the fact that you do see some in this K-shaped economy, you can have lower interest rates that helps growth and the like. Quite frankly, and I take kind of the other side of some of that. I don't think that interest rates being higher or lower by 100 basis points from here would have a major effect on the real economy one way or the other. You still see borrowing at pretty good pace. You still see corporations borrowing money for their AI builds. All of this means that maybe they just sit on their hands.
All right, well, we'll soon see, won't we, Ira? Thank you so much. So that is Ira Jersey of Bloomberg Intelligence. Coming up in the next hour, we'll talk inflation just a little more with Meera Pandit, and we'll also speak with the Firefly Aerospace CEO. Futures higher for a second straight day. Oil lower, yields just a tiny bit lower. And we also have the VIX lower, trading now with a 17 handle on the VIX. This is Bloomberg Open Interest. I'm Dani Quinn in for Matt Miller and Danny Berger today. Coming up, the AI-led rebound continues with investors finding fresh reasons to stay bullish on tech. OpenAI confidentiality files for an IPO as SpaceX prepares for its blockbuster debut later this week. And Apple getting a lukewarm reception as it makes the case that it can compete in the AI era. So we do have economic data crossing the Bloomberg right now. We have existing home sales and, of course, those surprising a little bit to the upside. Michael McKee, you can give us the data.
Now, we have very strong data for existing home sales. They're up 3.2% for the month of May. That's after a 7/10 gain in the month of April. And it's certainly way ahead of the 1.1% that was expected in terms of a percentage gain. In terms of existing home sales themselves, 4,170,000 at an annual rate, and that is up from 4,004,000. So we're looking at a fairly strong month. Now, the important thing to remember about existing home sales is that they're based on contracts signed about 2 months ago. And 2 months ago was when we hit our low in mortgage rates for the past couple of years, and it's gone back up again now. So this is probably not something that's going to continue for the next few months. In terms of the data, we get single-family homes up 3.5%. Condos and co-ops were flat on the month. So single-family homes, people out there buying maybe to close by the time school was over so they could move. But at this point, with rates going up, not sure that that's going to continue.
No, and I mean, I guess you have to take every good piece of economic data, you know, as a good piece of economic data, and a lot of wealth has been created in the country with markets at these levels. But what should we read about this? I mean, we heard earlier, you know, Toll doing so differently to, you know, home sellers out there that cater to the other parts of the K-shaped economy.
Yeah, well, Toll is on the top part of the K.
Yeah,
and
exactly.
The others more on the lower part of the K. And we know that there's a K-shaped economy with people who are making money off of assets and from the stock market doing much better than others. But with interest rates where they are, we're still stuck in the same situation we have been for years, in that a lot of people own houses with low mortgage rates and they don't want to sell their current house to buy something new at a much higher rate. So it's going to take a sustained drop in mortgage rates to really kickstart the home sales industry.
Would this be another way for Kevin Warsh to sort of say, you know, look, it's not a good idea to increase rates right now, you know, not just because the president maybe wouldn't want it, but also because, look, it could crimp home ownership? Well,
it probably is a minor argument. There are other reasons why he doesn't want to raise interest rates right now. And at this point, they're going to have to do a lot more work. You would have to have Fed rates fall significantly in order to influence overall mortgage rates, which are more pushed by the 10-year note than by the Fed numbers. And so markets at this point, you've seen, are expecting inflation, and they are then pricing for it.
Have to ask you about CPI tomorrow. We were very surprised by the payrolls data, we can't be absolutely certain that we know what's going to happen tomorrow when the numbers cross.
Well, there's a fairly strong feeling about what's going to happen tomorrow as people look at what overall prices have been. We're expecting a jump on a year-over-year basis, the headline number to 4.2%. That would be the strongest in about 3 years. And the core still under 3% at 2.9% is the forecast, but that's still way above what the Fed wants to see, and we're seeing basically inflation moving in the wrong direction. So we will expect to see some bad news on inflation tomorrow. It'll be bad news for the Fed, which doesn't want to raise interest rates, but maybe getting pushed in that direction if the war doesn't end and these price rises continue. Also, bad news, obviously, for the White House and Republicans in an election year.
100%. Michael, you'll be bringing us those numbers as they cross tomorrow morning. Thank you so much, Michael McKee. And we're staying with CPI now. Meera Pandit, Global Market Strategist at JPMorgan Asset Management, expecting tomorrow's print to come in at 4% plus. Adding, quote, gasoline prices peaked May 22nd and have been falling since, which may mean the next CPI report will show easing energy pressure. Meera joins us now. Certainly, if you were to look at oil prices dropping day by day, you would expect that. Nevertheless, the Strait of Hormuz is not open. I think that's what the price of oil depends on, although you wouldn't know these days. But what's the likelihood that, we don't see inflation come back down, that it stays at a 4% handle for a few more months?
What we'll probably see is this peak in inflation happening with this upcoming print above 4%. But then, as I noted, with gasoline prices ticking down gradually, you may actually see a little bit of easing energy pressure in the following month's CPI report. Now, that doesn't mean inflation is going to come back down to 2%, but there are various factors that may weigh on inflation for the rest of the year. If we start to see more of that peaking within energy, that could pave the way for gradually lower inflation. We also are seeing that the effective tariff rate has come down relative to last year, so you may see some easing on that core goods measure. You've seen shelter continue to ease as well, and wage growth has not been all that strong. So if you put all of that together, that may mean that the worst of inflation could be just in our sights. But the question to your point is, how long does it take to get into a more comfortable range for the Fed? Because it could take a while to pass through that 3% range on a headline basis, in which case we have to think about this mosaic of inflation pressures. What is the direction of travel in terms of wage growth and overall labor market? How do we see elements that have been very important to the Fed, like core goods? And again, how persistent is this oil shock, given the fact that you see it swinging so much with headlines, but hopefully receding some of that pressure on gasoline prices?
Well, we're going to have to see what the secondary effects are, right? Because the Fed will look through just oil on its own. They'll be wanting to see what is it actually impacting longer term. Kevin Warsh himself has quoted the old line about the last mile on inflation being a marathon. What does the Fed do about this?
This is also compounded with the fact that inflation may be slow to get truly down to that 2% target, as it has been for years now. It feels like every time it's within sight, as it was in the beginning of this year, we have some sort of shock or some sort of setback. This is now being compounded with the fact that there are these inklings of some sort of economic reacceleration. Now, the question here about that economic reacceleration, you look at things like the U.S. Economic Surprise Index with a 3-year high in surprises, is this really a function of lower expectations because of the war and expecting to have a bigger knock-on impact? So we're surprising to the upside of that reason. Are we actually seeing genuine reacceleration, or is this somewhat of an AI mirage? Because if you look at the components of GDP, yes, that CapEx spending has helped to support broader GDP growth and therefore keep us at a reasonable level and perhaps exceed that level in the second quarter. But the consumer, I'd say, is stable, resilient, but being weighed down by these higher gasoline prices, particularly at the lower and middle income segment. And the upper income individuals are still sort of preserving that consumer backdrop because they are more impacted positively by tax refunds higher than gasoline prices higher. So you put this together, you still have that K-shape from last year. Are you seeing acceleration, or are you just seeing the economy hang in there? That's another dynamic that the Fed has to debate, not just this inflation piece, but the growth.
Well, we don't have to debate it if we start seeing it in the data. So where are you looking to start seeing cracks in the data? Because we certainly didn't see it in the jobs report, even in the wage component of that. I mean, it wasn't runaway wage, hikes, but there were some decent growth figures there.
The wage growth is still muted and relatively moderate in our view, and therefore, when you think about how that feeds into inflation, not likely to add additional upward pressure. Now, the job creation has been strong over the last few months, and so you do see some stabilization there, but these are by no means huge job growth numbers either. So you have to think about the Fed sort of on this platform of reasonable job stability, but not necessarily massive growth. You think about some of the other data, too, as it relates to, for example, the overall economic backdrop and things like the consumer. Savings rate very low, consumers feeling extended, consumer sentiment feeling poor. That doesn't always translate directly to overall economic growth and spending, but you're not seeing that huge uptick in spending, and ultimately the consumer is 70% of the economy. So a stable economy does not equal reacceleration, and I think that's something we need to be mindful of.
So what does it mean for you as you look at global strategy at JPMorgan Asset Management? We had Fitch, for example, today talking about downgrading may not be the right word, but many global sovereigns were moved from neutral to deteriorating in Fitch's outlook.
When we think about the overall growth backdrop, it's also going to affect different economies in different ways. We are seeing that the U.S. is seeing that higher inflation, but is still seeing a reasonable growth outlook. But you compare it to an area like Europe, where there is potentially more sensitivity around the inflation front, there is potentially more sensitivity around the growth front. You compare it to a place like China, where there is demand destruction going on from an oil perspective, but is that also a function of an already relatively weak economy and relatively dour consumer there? So there are a couple of different cross currents going on here. It's hard to make a generalization across the globe because people are coming from a different energy inventory backdrop. They're coming from different pass-throughs there as well.
In the areas that you're invested in already, or is there anything that's starting to look attractive? Interestingly, in that Fitch report, China was the only country that actually saw an upgrade to neutral.
The economy is not the stock market. I think that is so important when we think about how we invest, because you may have varying growth outlooks across the world, but what we really want to think about is what are the different catalysts for earnings. And as we see areas like tech as not a huge portion of the overall economy or the overall jobs market, is obviously a huge portion within the U.S. of the stock market, and increasingly in different emerging markets like Taiwan and Korea, where there's that heavy concentration. If there continues to be demand around AI, and this is a story that starts to not only unfold within the tech sector, but within the broader infrastructure landscape, that continues to be an area that we want to be selective in and participate in that secular longer-term trend. When we think about some of these cyclical areas of the market too, in areas like Japan and Europe, you're still seeing areas like industrials, banks, having some legs here and providing a bit of a counterweight to some of the heavy tech exposure in other parts of the world. So I think that right now, because we have seen earnings in many different regions still hold up reasonably well, that's how we want to think about guiding our investment process. And so until you see massive deterioration in earnings, we are still relatively constructive on the equity backdrop across the world.
Are you concerned about cracks appearing at all? I mean, we've had the yen trading above 160 for a couple of days now, and all the talk about intervention has just gone away. It seems like that was 2 weeks ago, and there are bigger fish to fry.
We always have to be mindful of the different cracks that are out there, whether it's cracks that will surface themselves within the bond market and bond yields or within the equity market. So we are always attuned to the risks and the risk backdrop, but we also don't want to over-index to the risks out there, because what we have consistently seen over the last several years, particularly in the US, is a lot of upside surprise, not only in terms of the economy, but also in terms of growth. So we do need to be mindful that that upside surprise in the long run is what helps us get to our eventual investment goals, because it does allow us to grow portfolios. So we want to be balanced about the risks at hand and the indicators, because there are some cross currents of some scarier headlines and some genuine resilience in areas of solid data. So we don't want to over-index one way or the other, and we do want to seek some balance in that environment.
Meera, thank you so much. Meera Pandit there of JPMorgan. Let's get a check on these markets now. A nice green day, particularly for smaller caps, with the Russell 2000 up 1.8%. But you are seeing the Nasdaq up another third of 1% off its highs of the day. The S&P 500 now up another 0.5% after yesterday's gains. We're seeing the VIX trading just below 18. A little bit of deterioration, I would say, as we enter the second half hour of this trading day. And then the 10-year yield down a couple of basis points to 454.03. Of course, oil is underpinning most of this, with WTI and Brent both down 3% plus when it comes to just the near month contract. Let's look at some individual movers now at this hour. Tech continuing to drive the market as chip stocks extend their rebound from Friday's slump. Investors giving a lukewarmish reaction to Apple's next generation AI platform, which was revealed at the Worldwide Developers Conference yesterday, down about 2.4% there. And then we're watching shares of neo-cloud companies. So Applied Digital signed a 15-year deal with an as-yet unnamed US-based AI hyperscaler. I guess we'll get the name at some point, but that stock moving already before we do. Coming up, Broadcom extending gains as it teams up with Apollo and Blackstone to launch a $35 billion AI infrastructure platform. We'll have details next. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. Taiwan weighing tougher controls on AI chip exports to China, including making chip smuggling a criminal offense. The move would align Taiwan more closely with the United States restrictions and marks another escalation in the global race to control advanced AI technology. Knicks owner James Dolan is cashing in as the team makes their first finals appearance in 26 years. Dolan's net worth is up $450 million this year as MSG Sports shares surge. The Sphere turns profitable, and investors bet a Knicks spin-off could unlock billions in value. Apollo and Blackstone have put together a $35 billion financing deal to help power the next wave of AI. Money will help Broadcom build computing capacity for AI companies like Anthropic and OpenAI, with Anthropic set to expand first as new data centers come online starting next year. Let's get more on this debt deal now with Bloomberg private credit reporter Emily Graffeo. Emily, talk to us about the structure of this deal. It's a fascinating deal and has, I don't know how many participants, all sorts of levels to this deal and an SPV. What more could you want?
Yeah, there's a lot going on in this deal that we've been reporting out, but essentially it's one of the largest private credit deals ever. Apollo and Blackstone are coming together to basically create this SPV that then is going to raise debt from both Apollo and Blackstone, but also other investors. The money is going to be used to purchase chips, semiconductor chips that power AI. This most recent capital raise specifically will first be used by Anthropic. So Anthropic will lease the custom chips that Google and Broadcom have partnered to create. If you zoom out a bit, what it's basically showing us is that chips are really expensive, and Wall Street needs to come up with these very creative financing structures to be able to create the money to buy chips for AI.
Yeah, and I was looking at the third tier, you're getting something like an 8.5% coupon. How does that compare to sort of other corporate offerings?
Yeah, so there's 3 different tranches in this debt. The first 2 are investment grade, like mid-investment grade, and they're backed by Broadcom. That third tranche, the B tranche, what we're calling it, has about an 8.5% yield. That one's not backed by Broadcom, so there's a little bit of a maybe safer rating in the first 2, and then if you want maybe a little bit more risk.
Yeah, absolutely.
You're in that B tranche.
Now, Apollo and Blackstone coming together on this, I mean, these are the major players. Will we see smaller players trying to do maybe smaller deals, or will they just eat up all of the supply here, the big players?
Yeah, I mean, that's a good question, Bonnie. It's definitely like, you would expect that the largest alternative asset managers come together and create a deal of this size. What we know also is that they are going to be keeping roughly half of this $35 billion, and then they'll syndicate it out to other investors. It's not too different than what we saw last fall with the Morgan Stanley Beignet Meta deal. This is kind of similar, where there's like an SPV involved, there's a tech backstop, and there's some private credit involved.
Yeah,
as
something
well.
for everybody. Now, would this be the type of thing that banks would pass on and would just not consider, themselves suited to, or will we also see banks getting involved in this?
I think we'll see banks getting involved. At least for this one, there was Morgan Stanley did help arrange the transaction, and it was advised by Morgan Stanley. And then I don't have it in front of me, but I know there was at least one of the tranches, the A1 tranche, that was sold to banks. You might imagine that then some of that they syndicate out. So there is still a bank involvement, but the headline here is there's a huge financing, and the alternative asset managers are doing it. It's Blackstone, it's Apollo.
Exactly. Now, the syndication that goes out to other investors, I mean, will there be endless appetite for that? Could we see, an unlimited amount of syndicated, financing here for investors that might be interested?
I mean, we'll have to see. This, again, the Broadcom backstop involved in some of the tranches might entice some investors to get involved, but this likely isn't the only AI financing that we'll see this year. There's a lot of data center debt that's already been raised. This is a little bit different because it's chip financing, so there could be more of that coming down the pipeline for this year. So you have to imagine investors might get they might be discerning. If they don't want this deal, they know, one's coming in just a few weeks. Why take this one?
Now, Broadcom backstops the chip part of it. Is there any possibility at all that Broadcom runs into trouble, or that it loses a client, and then maybe it finds it a little bit more difficult to sort of make good on those lease agreements or what have you?
I'm not exactly sure how that would play out if Broadcom were to run into trouble. At least what we know right now is that Anthropic is going to be leasing those, the chips that Broadcom and Google create. Right now, Anthropic needs a lot of these chips.
Yes.
Whether or not they continue to need the chips indefinitely is certainly an open question.
Yeah, absolutely. It's a bit like being on a children's sort of playground area, and if one child comes off the seesaw, what happens to the other children? All right. Emily, thank you so much. Emily Graffeo there, bringing us through the details of that pretty complicated investment structure. Stay tuned for our coverage of Super Return tomorrow. Dani Berger is going to be speaking with 6th Street co-CIO Julian Salisbury, Apollo co-president Scott Kleinman, Churchill Asset Management CEO Ken Kensell, and Thoma Bravo co-founder Orlando Bravo. Coming up, Anthropic's rival OpenAI joins the massive IPO pipeline, which is now worth nearly $4 trillion. That's still ahead on Bloomberg Open Interest. This is Bloomberg Open Interest, a little check on stocks now, and we are higher. For the most part, we are seeing nice gains, although we're coming off our highs of the session. The S&P 500 up just 1/3% now. The Nasdaq really erasing some of those gains, up 0.2%. It was up more than 1 percentage point earlier. The Russell 2000 also down from where it was, but a nice gain still of 1.6%. Semiconductors look to be a little bit the villain here, up just 0.4% as a group. A deal over here has Nuvalent up 40%, Micron up 1%, and Applied Digital on that 15-year deal with a hyperscaler. Apple also extending declines. The Worldwide Developers Conference didn't please everybody, it seems. And Nvidia has now turned negative. Well, there you go. That's our answer. All right, do stay tuned. More answers after this. We'll be speaking with Firefly Aerospace CEO Jason Kim about the race to the moon and back.
I think it's a signal that the commercial industry and the innovation is there. So I think overall it's positive. I think creating that awareness also with the private sector, so your venture capital, your private equity, that this is becoming a commercial opportunity where there's actual revenues, which is the key part to this. I think it's opening everyone's eyes.
Ross Hamilton there, COO of Space Network and author of Everything is Flying. He was on Open Interest yesterday. Now, SpaceX, OpenAI and Anthropic are lining up for blockbuster public debuts. History not quite on their side. Many marquee tech IPOs stumbled in year one, but these industry leaders may have what it takes to rewrite the playbook. Let's discuss with Bloomberg Equities reporter Carmen Reinecke. So first, just in general, there's a bunch of IPOs out there in the year. 1 year on, are they typically trading higher than their first day's prices or lower, Carmen?
We had this great analysis from Truist that showed pretty mixed trading at the 1 year mark. So some were up, some were down when you look at the top 30 IPOs of the last 15 years or so. What was interesting is that within that year, the average drawdown was 55%. So that's huge. That shows some really incredible volatility in the first year of trading. And if you just look at some of the biggest, IPOs on the tech side, if you look at Meta and then, another Elon Musk IPO, Tesla, you see a ton of choppiness in that first year as, more shares come online, as IPO expiries, come, and as earnings come out. There are just a lot of catalysts that can move these stocks.
Well, and as some of these stocks are entered into indices as well, right?
Exactly.
I mean, so there's a lot to consider. But many of these space-related stocks have already seen huge run-ups. So I'm looking at Rocket Lab up 273% year over year. Satellogic up 86%. Intuitive Machines up 141%. Can we base our, impressions off those and say, well, at least the space-related stocks should go higher?
That's a great question, and I think it'll be really interesting to see what starts happening when SpaceX starts trading. So we've seen a lot of enthusiasm around the space stocks, but at the same time, it seems that a lot of investors are sort of wanting to take some dry powder, keep it on the sidelines to invest in the SpaceX IPO. And we know that retail investors are so important here. Something like 30% of the shares being listed are sort of allocated for the retail space. So it's interesting to see that there has been so much enthusiasm around space, but I'm going to be curious and watching and talking to investors to see if some of that shifts over to SpaceX once it comes online.
Talk to us about the $135 price, because usually, price discovery happens an hour or two, well, I mean, days and weeks before the actual trading, but then even once it starts trading, whatever it goes public at might jump 60%, then drop 30%. I mean, we've seen it all year long with these IPOs. Now that we know it's going to be $135, what's the street saying about that?
Well, it's something that's so interesting because it's one of the reasons why this is so different, right? The SpaceX process has been so different. It's been very fast, and we do have this set price. Usually we're waiting to see where the pricing is in this range, and that can affect sentiment, going into the first day of trading. We're not seeing that this time, right? We know it's going to be $135, at least that's what we're expecting. And so it'll be really interesting to then see how it opens on that first day of trading and where it goes from there.
Yeah, it's definitely going to be an event. I think that's one thing we can say with absolute certainty. Carmen, thank you so much. That is Bloomberg's Carmen Reinecke. SpaceX's IPO putting a spotlight on the broader space industry. Firefly Aerospace successfully landed its Blue Ghost spacecraft on the moon last year and has since won a new NASA contract with several lunar missions planned in the years ahead. Pleased to say CEO Jason Kim joins us now. So Jason, congratulations on your results. You did call your first quarter solid. It was a solid print. Have you any more updates to your full year guidance for us?
No updates from what we said in first quarter, but what I would say is there's a lot of things that have changed just in this year. If you look at the moon, NASA is going to go back to the moon with humans with the Artemis program. And if you look at just 3 months ago, the NASA administrator said, hey, he's going to spend $20 billion on creating a moon base. And then within less than 3 months, he put companies on contract like Firefly. You saw that we won a $75 million JPL mission called Moonfall that JPL is leading, and we're going to support them with our Electra spacecraft. So there's a lot of great catalysts like the moon. We're also in Golden Dome as well, one of the 12 contractors on the Space-Based Interceptor program, and that's a growing area of interest by the Department of War. And then there's more things that we could do in space. We have a Defense Innovation Unit contract called Cinequan that we're supporting to do space domain awareness processing in space with our Electra spacecraft. So it's an exciting time for us.
We were just talking about the SpaceX IPO, Jason, and I'm curious because you IPO'd last year. A little bit of a wild time, of course, for anyone who IPOs. The stock down nearly 20% year over year, but you are up more than 60% just year to date. What would you say to those who are IPOing or who might want to participate in an IPO? Did you hear a lot of comments from shareholders in your company after the IPO, and many of them negative, some positive, I'm sure?
What I would say is that space is consequential. There's more and more happening in space, whether it's orbital data centers or national security reasons or the moon base and beyond. So it's a very growing area of investment. The ecosystem is continuing to grow on the moon as we speak. What I would say is that nothing's changed for our focus at Firefly. We're focused on execution and increasing our delivery cadence for our rockets, our satellites, our lunar landers, and now our AI defense software as well.
There was a little bit of setback to some of the space stocks after the Blue Origin rocket explosion. And I'm curious, is that a major risk for a Firefly? You do some things that are similar to other companies in the space. If one has a problem, are you all tarred with the same brush? Do you all see your stock prices and metrics and interest suffer?
I think what it shows in the space industry is how challenging these missions are. And it's a huge moat to have your own launch capabilities, and Firefly has our own launch capabilities. So not only do we have the hardware stack, but we have the software stack, and we have the entire end-to-end ecosystem to launch our own satellites, build our own satellites, operate our own satellites with applications on orbit. This is a challenging industry, and that's why we're focused on executing.
Why do investors seem to be more interested in satellite and rocket companies, Jason? I mean, this obviously benefits you, right? But some of the companies that I was citing there have had bigger gains than others due to what they actually do. So, you know, if you're looking at Voyager, for example, you know, it brings things to the moon to help out infrastructure-wise and stuff. So why the rockets? Why are they so interesting to people?
Well, you can't get access to space without the rockets. It's incredibly hard to, get out of Earth orbit and into LEO, MEO, geosystem, and beyond. And so that's what we're able to do with our 1-ton Alpha rocket that has done 24-hour responsive launches for the Space Force. And we have a number of contracts to do more of that. We're also doing hypersonic missile testing using our Alpha rocket as well. So we can get mission-unique payloads to their dedicated orbits very responsively. And then we've got a 16-ton reusable rocket that we're co-developing with Northrop Grumman that will take even more national security constellations and commercial constellations, as well as potentially even lunar landers in the future. And so with that access to space, now you can start doing things in orbit, in space, on the moon, and Mars, once you get there with a launch vehicle.
What about the $12 million share secondary offering? Can you give us more details about what you will do with the proceeds from that?
Like we said in our roadshow there, what we're going to do is, invest in our current programs and our new wins. We're always constantly improving our technologies, improving our reliability and repeatability in delivering our rockets, landers, and orbiters as well as our defense software. So we're going to continue doubling down on those capabilities. As you saw from before, we were already investing in a larger capacity for all of our products. And so even before the Moon Base initiative, we were quadrupling our clean room space here in Cedar Park, Texas. And we have now a 144,000 square foot campus here where we can rate up more landers, more orbiters, so we can increase the frequency of moon missions every year.
Yeah, you've been talking about how you're going to benefit from funding increases to the Space Force budget. Which of your vehicles, which of your launchers are best positioned to benefit from any increases?
If you look at it, we have multiple shots on goal for national security and Golden Dome kind of programs, whether it be our responsive launch capability with our Alpha rocket or launching national security constellations with our Eclipse rocket. And then our orbiters, they're capable of taking ample payload capacity to orbit, and they have high maneuverability and high thrust and a lot of fuel on board, so they can do a lot of sustainable, long-lasting missions for the Space Force. And then our SciTech Defense AI software, it's really helpful for things like Golden Dome because the threats are quick, they're maneuverable, and they're lethal, and the AI really helps to defeat and deter those type of threats.
Jason, we might be a little bit, away from this yet, but I'm curious, do you think at some point there will be some consolidation in the industry, given that some companies are doing the same thing and maybe don't have a huge economic moat?
I can't speak for other companies, but for Firefly, we have a multi-year strategy, and we're just executing it. And it's about, improving our technologies, delivering them repeatedly, reliably as we launch, land, and operate more and more. And we have a lot of tailwinds behind us with the Moon Base initiative, with launch and, launching constellations, as well as orbiters to do national security and space exploration missions. And then you add to it our capability to do AI software now on those platforms.
All right, Jason, thank you so much for coming on today and this week in particular. Firefly Aerospace CEO Jason Kim. Let's get a check on these markets now, just more than an hour into the trading session. We are still seeing gains, but erasing many of those gains now, in particular the Nasdaq 100, back down to flat. We'll see how this progresses throughout the afternoon. Nvidia had turned negative earlier, so that was partially the drag on this market. Taiwan mulling curbs on AI chip exports to China, no doubt not helping this market as well. And then we also just have maybe a little bit of fatigue and a look ahead to some of the massive stocks that are going public later this week and this year. So let's take a look at some individual movers this hour now. Vail Resorts cutting its income guidance due to what it's calling historically challenging weather conditions in the western US. Avocado supplier Mission Produce rising after reporting better than expected sales, even as revenue declined due to a drop in prices. And then a massive drop for software company SailPoint, even as it beat estimates and boosted its forecast. It wasn't enough to impress investors. Coming up, better Siri, faster file transfers, and features for a foldable iPhone. More on Apple's AI overhaul next. This is Bloomberg Open Interest.
At Apple, creating the best products in the world to deliver experiences that enrich people's lives has always been our North Star. It's been the honor of a lifetime to help advance that mission with teams whose creativity, care, and conviction continue to make a lasting difference in people's lives.
Tim Cook speaking yesterday as he closes out his final Worldwide Developers Conference as CEO. Apple's AI roadmap giving investors clues about its foldable phone ambitions. The iOS update has references to folding hardware and new features for larger displays. Let's discuss with Bloomberg Intelligence senior analyst Anurag Rana. So going out on a high note, leaving some products for his successor. Anurag, are they going to be any good?
Yeah, so I think he is definitely leaving on a high note because Siri was a big blot on Apple's face for, the last, 12 to 18 months. Then in November, Mark Gurman reported that they're going to be using Google's technology to take care of the models that are underlying Siri. And we saw, I think, a decent, I would say, demo yesterday of all the functions it can use. I think it's only going to go up from here, especially because Gemini models are doing really well right now in the market.
And people always seem to forgive Apple, right? They generally don't come out with the best version of anything the first time round. We all fall for it. We're mugs, we buy it, and then we sort of have to wait till iteration 2 or 3.
Well, that's the case, but I think they were also caught a little unaware with how fast the consumer AI really rebounded, and they really didn't have their models ready at that time. But at the same time, are you going to switch your entire life because somebody else's phone has a little bit more better AI? Especially when you can download these apps. Because remember, you could still download OpenAI and Gemini on your phone and use it. It was just not natively built into the operating system. And that's what we saw yesterday.
Will it be enough to have a whole generation upgrade their phone?
So the question really is, this year we've seen a really good increase in iPhone sales. Last quarter was good. The quarter before was very strong. And they've guided to a good quarter. What's going to most likely happen in our view is they're going to come up with this new series going to be launched by the end of the year. It's going to take some time to be available across all geographies. People are going to start to use it and talk about it. So I think sometime in the middle of next year, we should see some pickup in phones because we think about more than half the install base of Apple currently is not what we call Apple Intelligence ready, which is these are older phones that cannot run Apple Intelligence. Those are the models before iPhone 15 Pro and Pro Max. Everything below that, you cannot run Apple Intelligence. So if this program is successful, you should see some refreshes of those phones.
Should we be excited about the glasses and other wearables that are coming?
I'm more excited about the foldable phone because it seems from even yesterday's release, there are some hints that that's going to come out. But at the same time, Mark Gurman's already reported that's going to be a $2,000 phone that's going to come out this fall. They have been behind in foldable. So that's going to be another, but I think that's going to come as part of the new CEO's arsenal of new products that he'll be launching.
Dying to know what you think about the idea that Taiwan is thinking about curbing sending AI chips to China. We're out of time, but if you could give me a quick thought.
It's going to be tough to execute that, and China itself may not actually use some of those chips. They want to do it in-house as well.
Okay, all right, so maybe not the Armageddon scenario. Okay, Bloomberg Intelligence senior analyst Anurag Rana. Coming up, Brent crude moving lower as President Trump says negotiators are in the final throes of a deal. That's next. This is Bloomberg Open Interest.
We have ongoing negotiations with Iran, and that hasn't stopped. We're in the final throes of what will be a very, very good deal that will not allow in any way, shape, or form nuclear weapons, etc. And the Strait will open up right away. It'll open up immediately upon signing, which could be in 2 or 3 days.
President Trump there speaking in New York last night. Brent moving lower as the president renews his claims that progress is being made towards ending the conflict in the Middle East. Let's get the latest with Bloomberg's Kayleigh Lyons, co-host of Balance of Power. Kayleigh, are you speaking to anybody that says the Strait of Hormuz will be operational and soon?
Frankly, no, Vani. And the way you characterize that he's claiming that we're getting closer to a deal is the correct way of doing so. And he's made those claims repeatedly for some time now. If you think back to May 29th, 10 days ago, when he said that he was going to go into the Situation Room and make a final determination on a deal with Iran to see the Strait of Hormuz open, no such determination was made. There is still no deal in hand. So you can't always take the timelines that the president has laid out as gospel, Vani, and that has been proven time and again over the course of this conflict. That said, he does still seem eager to reach a deal with Iran. He says Iran is eager as well, though we consistently hear different messaging from Tehran about the progress of negotiations. They suggest that it is not as optimistic as President Trump is casting it to be, but he still maintains that there will be in short order an end to this conflict and a reopening of the Strait of Hormuz. And we heard him once again yesterday suggesting that gas prices will be dropping precipitously once this comes to an end. But of course, we're still north of $4 a gallon on average across the country. And that is a big problem for the president and his party as the midterms draw closer.
True, although I suppose we do have to keep in mind that it is a flip the switch scenario. If there is an agreement at some point, well, then both sides just back off the strait, right? Let's talk about the primaries, Kayleigh, because we do have a fascinating set of primaries still ongoing. What's going to happen in Maine with Plattner?
Well, it's likely that he will secure the Democratic nomination to take on the incumbent Republican Senator Susan Collins. The Maine governor, Janet Mills, is still on that Democratic ballot, even though she suspended her campaign due to what she cited as a lack of financial resources. So it is likely that Plattner is going to be victorious in this primary. That said, he has been plagued recently with a series of scandals. His wife revealing to his campaign, that was then revealed to media, that he had been sexting individuals outside of his marriage early on in it, that there's been allegations aired by women who used to date Graham Plattner in the New York Times, accusing him of toxic and unsettling behavior in romantic relationships. There is a tattoo of a Nazi symbol that he had as well, former posts that he had made on Reddit. There is a lot stacking up against him that could make the politics around his campaign more difficult heading into a general election in November against Susan Collins, who is, by the way, an incredibly vulnerable incumbent. She obviously has had to break with President Trump on a number of issues recently to try to keep that independent streak that seems to win over the voters in Maine. And Maine is a key pickup for Democrats. If they have any chance of flipping the Senate in November, keeping in mind they need to flip 4 seats, Maine is a crucial one in that calculus. So if Graham Plattner can't pull it off in November, it makes the chances of Democrats getting a fresh hold of power in the upper chamber much more difficult.
And a key primary in South Carolina as well.
There's a number of them. There's the gubernatorial primary in which the president has made an endorsement in the lieutenant governor, Pamela Yvette. But there are other House members vying as well. Congresswoman Nancy Mason, Congressman Ralph Norman of the Freedom Caucus are also in the mix here. It's likely going to go to a runoff. But once again, this is going to be a test of how potent a presidential endorsement, a specifically President Trump endorsement, is in the primary cycle, depending on how far ahead Yvette may come out in these ballots. There's also going to be some interesting action in the Senate primary. Senator Lindsey Graham, of course, running for a 5th term. He is a longtime figurehead here in Washington, but his race actually could ultimately go to a runoff as well for the first time in his career, which just speaks to the idea that there is a bit of a rift in the Republican Party between a traditional establishment conservative, hawkish conservative like Lindsey Graham, who has been such an advocate for the war in Iran, and the rest of the party, which is much more averse to conflict internationally.
All right, Kayleigh, thank you so much. That's Kayleigh Lyons there, co-host of Balance of Power. Do catch her at 1 p.m. and then again also at 5 p.m. Eastern. Coming up tomorrow, Mike Wilson of Morgan Stanley, Lori Calvasina of RBC, and Blackstone Capital Partners head Martin Brand. Markets have turned negative now with the stocks down nearly 2%. This is Bloomberg.